Imagine you enter into a grocery store and every time you visit, prices have changed. Now, during the 2022-23 inflation surge, this happened more often than in the past, as firms were changing their prices more frequently. This puzzled many economists because, based on standard models, firms are assumed to change their prices at random intervals of time, independent of economic conditions. In reality, however, firms do choose the time of their price adjustments based on the economic environment, including the shocks that they face. This research is important, I think, because it dives into the question of what central banks should do in a situation when firms change their prices more often, as during the inflation surge of 2022-2023, after a large shock. My main findings are three. One is that after a large inflationary shock, central banks should fight inflation fast and hard. Think of fighting inflation as putting out a fire. If you wait too long, the fire spreads and the damages are increased. Now, the typical way central banks fight inflation is by raising interest rates. This, however, has the disadvantage that sometimes temporarily output and economic activity are suppressed. Now, if firms change their prices more often, such as after a large shock, that actually means that it is less costly for the central bank to fight inflation in terms of lost output. So, in other words, it makes sense to strike while the iron is hot and act aggressively during the inflation surge. This means that central banks should raise interest rates fast and steadily during an inflation surge. The second finding is that the relationship between inflation and output is not simple. Traditional models assume that inflation and output have a linear relationship. It works like a dimmer switch. You increase inflation a little bit, and that helps you boost growth by a little bit. However, large shocks break down this relationship, and it turns out that it becomes nonlinear. That also means that when firms reprice more frequently, it is less costly for the central bank to tame inflation in terms of lost output. What is known as the Phillips curve steepens or the sacrifice ratio lowers. So therefore, it is important that central bank seizes the opportunity to strike while the iron is hot and lower inflation while it is cheaper to do so. The third finding is about the fact that in traditional models, there is a temptation for the central bank to temporarily boost inflation in the short run in order to increase growth. This is less so in the novel model because firms simply increase the frequency of their repricing, and it makes no sense to trick the economy this way. What does it mean for central banks? Well, first of all, it means that after large inflationary shocks caused by increases in costs, for example, it makes sense for the central bank to strike while the iron is hot, that is, to be aggressive and not wait too long before inflation has spread widely. Secondly, it means that the cost of lowering inflation in terms of output is much lower when firms increase the frequency of their repricing. And third of all, the 2022-23 inflation surge, it was appropriate for the central bank to raise interest rates steeper as prices were rising.